Hi, everybody. This is Sep Ibrahimi, Berkshire Hathaway Luxury Division. Hope all doing well. Came across some interesting information, and I thought I'll share this information with you. So let's just jump into it. So I'm going to go over the market update, and I'm going to start with what Mark Fleming says, chief economist at First American, that housing has experienced a strong V-shaped recovery and is now exceeding pre-pandemic levels. So there's a lot of areas that we see economical issues, but real estate market has not been one of them. They actually bounced back. So I'm going to show you some data to back it up. For example, housing market recovery index, which is actually four different components goes into this index, which put together by Realtor.com. It has demand, supply, and price, as well as a time on the market. If you look back from January 2020, it was at baseline at 100, and the market was continuing pretty strongly the first few months up to March timeframe, where the pandemic started. And you can see a big drop from 106 down to 83. And from then on, the market has been on a pretty much a V-shaped recovery, a real estate market, that is. And we are actually above the levels of back in March timeframe. So this shows that, basically the full force real estate is back on target. Let's look at the year-over-year changes in key matrices. These are really important. Let's look at the first one, showings. Showings are up by 60%. This is year-over-year. This is a huge demand on the buyers. There's a purchase applications are up 25% year-over-year. Again, a lot of people are applying for loan, even though it's harder to get a loan, but it's not stopping the buyers. They all wanted to lock in the low rate. Pending deals are up 21.8%. Existing home sales are 10.5%, and the new homes are actually up 43% from a year ago. What's not helping is existing home inventory. Inventories are down by about 39%, and the new home inventory is down by 33% across the US. These are the data, by the way, is provided by Showing Time, the Mortgage Bankers Association, Zillow, National Association of Realtors, and the National Association of Home Builders. So you can see that the real estate market is absolutely solid, and it's just what's missing is we're missing inventory. We don't have enough homes to sell, and that's what's hurting us right now. So let's see if we can keep this up. So what happened is, let's look at all the spendings by consumers. That's what the economy is about. If people spend money, the wheels of economy is turning, and then we have, people can purchase stuff and economy is improving. First few months, we were right about 0%, and boom, back in April, as everything gets shut down, we're down by 31%. And then you can see every month is climbing up, and by September it was down to only -4% as compared to -31%. So the economy is improving. Let's look at changes in consumer spending since January of 2020. The blue states are the ones that basically showing positive. So not only they're not behind, they're actually ahead of the January. The red states are the one are behind. So California, it happened to be one of the ones that still hasn't caught up, and probably has something to do with most of the jobs that are lost, had to do with the leisures and movies, and so a lot of those things has not, and restaurants, it has not come back yet compared to everywhere else. But overall, if you look at the overall, things are coming back, things are looking better. Let's look at the unemployment rate. So right before March, we were right about 3.5%, 4%. And then obviously right in April, when everything gets shut down, it went up to 14.7. But you can see the trend continuously coming down. We're down to 7.9% as of September. So things are looking good. This is from Business Labor Statistics. So unemployment comparisons shows great, so this is the comparing between how many months it took for different past 4 recessions. So during the Great Depression, it took 108 months to actually to have the unemployment be greater than 9%. During the Great Recession, it took 30 months. And back in the oil recession of 1980s, it took 19 months. This particular one for the pandemic was only the COVID, it's only 4 months, and we're already out of the 9%. So it kind of give you an idea of this was basically, we put a stop in everything. It was forced by the government and by the whole situation. So now it's coming back. So let's look at the number of mortgages in active forbearance, because that's something is in the back of everybody's mind, right? What happens to all these forbearances? Are the people going to be left with, they have to sell their home or they have to foreclose it because they cannot afford paying the payments? Let's look at that. So at the beginning of the pandemic, a lot of people start applying for it, even if they didn't need it, just to see what happens. But then you can see it steadily is coming down, and number of millions of people who have forbearances. So as of the end of September, we're down to 3.5 million from 4.7 million. Now, what is happening in the real estate market is that in lack of inventory is causing such a seller's market. Well, in addition to a low mortgage rate, which I'm going to go over that. So if you typically are over 6 months, 7 months of inventory is a buyer's market. That means things are not moving as fast. People are not that motivated to buy. So it's a buyer's market. Now, on the contrary, if it's below 6 months, 5 months, 4 months, you're in the seller's market. That means as soon as the home hits the market, it's already sold. So, or it very quickly goes to the pending. Therefore, we're down here in today's market. We actually, it's one of the lowest levels of we're roughly about 3 or 4 months, and it's pretty heavy. It shows that seller's market is very heavily seller's market at this point. Let's talk about the mortgage rate. The 30 years fixed mortgage rate is at all-time low. You can look at it in this chart, and we're down to below 3%. Money's on sale, and that's what prompted a lot of the buyers jump in the market, and they want to lock in this rate. So money's for sale. One of the important information it's good to know is how many percent of people actually have equity in their homes and how much equity they have. This is John Burns Consulting report that came up, and it shows that how many percent of homeowners have equity by this time 2020. And it shows about 42% actually have a completely paid off home. They have no mortgages at all. In fact, if you look at the number of people who have, about 20% or more, you're looking at about 87% of people have over 20% of equity in their homes. And this is a lot of money we're talking about. And that means if the market even crashes or goes down by 10, 20%, they're not going to leave their home and go to foreclosure. They have equities. If they have to tap into it, they can sell their home and they still have some money in their pocket. So it's a different environment compared to what it was back in 2008, 2007, 2008. Let's look at a projection on the future homes. All these big companies and big associations of, like Zelman, Fannie Mae, National Association of Realtors, they all have their own projections. But if you look at most of them, you can see that the majority of them, they're thinking that over the next 12 months, we're looking at about 3 to 4% increase in prices across the board in the US. There's only one estimate that thinks that next year we're going to actually decline by about 1%. So what's the obstacle? Since the beginning of COVID pandemic in March, nearly 400,000 fewer homes have been listed compared to last year. This is tremendous. This is a big number, and basically leaving a gaping hole in the U.S. housing inventory. And as a result, home prices are accelerating at double of last year's pace. This is a Realtor.com. So basically, we have a combination of low inventory, low interest rate, prices are moving up. And at this point, looks like it's going to continue, it's not going to slow down anytime soon. And year-over-year changes in the listings, you can see that back in early March, as soon as the pandemic hit, this number went below by 25%, start backing up. But then if you look at the total listings, so we were never able to recover from the total number of listings that are in the market and available for sale. So we're right about 40% lower than we were the same time a year ago. So this is low inventory environment, and we just don't have enough sellers. So the takeaway is basically, housing market is on a V-shaped recovery. All the key matrices are up, except the decline in the housing inventory. Consumer spending is getting closer to pre-pandemic levels. We discussed that, and unemployment rate is actually steadily declining, so it's getting to be more closer to where it's supposed to be. Mortgage forbearances are decreasing, so it's not as big a problem. There is a problem, but it's not as bad. And low inventory and low mortgage interest rates are fueling our real estate market. Substantial homeowners' equity should prevent flooding the disclosures and bank-owned properties. Again, people have equity in their homes, and we should not. This is not the same environment as it was back in 2007, 2008 crash. Hope you find this information useful. Share it, and if you can leave me what your thoughts are, maybe something we missed, something else that you can educate me, I would love to hear that. Thank you so much. Bye.